$725 billion. That is how much Amazon, Microsoft, Meta, and Alphabet, the four AI hyperscalers, are spending on artificial intelligence infrastructure in 2026 alone. Google, Amazon, Microsoft, and Meta collectively plan to allocate $725 billion to capital expenditures in 2026, up a staggering 77% from last year's already record-breaking $410 billion. Canada's entire GDP is approximately $2.8 trillion. These four American technology companies are spending more than 1/4 of Canada's entire annual economic output in a single year on data centers, chips, and AI compute capacity. And tonight, starting after market close, the results start coming in. Microsoft and Meta report Tuesday, July 29th after close. Apple and Amazon follow Thursday, July 30th. This is the single most watched earnings stretch of 2026. The single question hanging over markets: will mega-cap tech confirm or calm growing fears about runaway AI spending? The answer to that question will move your TFSA, your RRSP, and the TSX before the end of this week. This video explains exactly why and what to do with the results when they arrive. To understand why this earnings week matters so much, you need to understand what the $725 billion is actually being spent on, and why investors have started to question it. What the money is going toward: the four hyperscalers, Microsoft, Meta, Alphabet, and Amazon, are expected to boost capital expenditures this year to over $470 billion from about $350 billion in 2025. Note, different sources use slightly different figures depending on timing of guidance updates, but all sources agree on the approximate $650 billion to $725 billion scale and the 77% year-over-year increase. The money is going to massive data centers to train and run AI models, NVIDIA and custom chips to power the compute, power infrastructure, electricity, cooling, real estate, and fiber and networking connecting it all. Goldman Sachs now expects a combined $5.3 trillion of capex spending for the four largest hyperscalers from fiscal year 2025 to fiscal year 2030. This is one of the largest capital investment cycles in corporate history, comparable in scale to the build-out of the railway system in the 19th century or the early internet infrastructure in the 1990s. Why investors originally supported it? From 2023 through early 2026, investors largely gave the hyperscalers a pass on massive AI spending because revenues were growing fast enough to outpace the expenditure. Cloud revenue, the primary mechanism through which AI spending generates returns, was growing at 20% to 30% plus annually. The implicit deal: we will keep spending lavishly, and you will keep seeing revenue beat expectations. Why the deal started breaking down? For years, U.S. technology giants had a tacit agreement with investors. The companies could spend lavishly on artificial intelligence, and the stock market would reward them as long as their revenues were rising. That deal is suddenly breaking down. At this scale of infrastructure commitment, a revenue beat is not enough. What investors want to see is proof that the spending cycle is generating returns faster than the debt and equity issuance being used to fund it. Alphabet reported strong earnings last week, but Alphabet's strong earnings were overshadowed by a projected $15 billion increase in 2026 capex, sparking investor unease. The message markets sent: good earnings are not enough anymore. We need to see the spending come down or the returns go up. Microsoft reporting tonight after close. Analysts expect Microsoft to raise its 2026 capex forecast toward $238 billion. That would test whether spending discipline can offset rising memory chip costs. The key metric: Wall Street will watch Azure's constant currency revenue growth, with investors looking for growth to remain above 31%. Equally important will be management's commentary around enterprise adoption of Microsoft 365 Copilot. Microsoft's AI bet runs through Azure Cloud. If enterprise customers are genuinely adopting Copilot at scale and Azure is growing above 31%, that validates the spending. If Azure growth slips below 31% while CapEx continues rising, the market will interpret it as spending ahead of demand. Meta, reporting tonight after close. Meta enters the print trading near record highs, supported by robust digital ad impressions, plus 19%, and ad pricing, plus 12%. However, capital spending is the main swing factor. In its April earnings call, Meta raised its full-year 2026 capital expenditure forecast to $125 billion to $145 billion, up from a prior range of $115 billion to $135 billion. The stock fell approximately 10% in the session following that disclosure. The key metric: whether operating margins hold above Q1's 41.4%. Meta trades as an AI infrastructure story. The single swing factor is FY26 CAPEX guidance, $125 billion to $145 billion current range, and whether operating margins hold above Q1's 41.4%. Meta's AI spending goes primarily to building its own AI models and Advantage Plus advertising AI. If ad revenue is growing faster than the infrastructure cost, the market will reward it. If CapEx rises again without corresponding margin improvement, expect a repeat of April's 10% drop. The combined setup: we're in a period where people are inclined to sell off on CapEx, and Microsoft and Meta and Amazon are all holding hands with Alphabet and jumping in to spend. Markets are primed to punish additional CAPEX increases and reward any sign of spending discipline or accelerating returns. Tonight's calls are genuinely binary in their market impact. Here is the vault, the one company reporting this week that has taken the completely opposite approach to AI spending, and whose stock is up 15% in July because of it. Apple, the capital-light AI outlier. The iPhone maker has avoided big AI outlays, opting instead to partner with model developers to power its services. Investors have rewarded that strategy in recent weeks, sending the shares up 15% in July and putting them on pace for their best month in exactly 3 years. While Amazon is committing $200 billion, Microsoft is heading toward $238 billion, and Meta is spending $125 to $145 billion. Apple has deliberately chosen not to build its own frontier AI models or massive data centers. Instead, Apple integrates third-party AI, including partnerships with OpenAI, into its existing products: Siri, Apple Intelligence features, productivity tools, without the enormous infrastructure cost. Apple has leaned on a capital-light AI approach, avoiding the outsized spending pressuring rivals. Analysts expect revenue near $108.9 billion. Tim Cook's final earnings call as CEO. A historic moment, and one where the capital-light strategy Apple has pursued will either be validated by strong results or questioned if services revenue disappoints. What this tells us: markets in July 2026 are sending a clear signal. The question is not who is spending the most on AI. It is who is generating the most return per dollar spent. Apple's approach: leverage existing infrastructure and partner relationships rather than build from scratch, is being rewarded precisely because investors are exhausted by capital expenditure announcements without corresponding return visibility. This does not mean Apple's approach is superior long-term. The hyperscalers who build their own infrastructure may have decisive strategic advantages in 5 years. But in the near-term market environment of July 2026, where every capex increase is punished, Apple's restraint is the winning trade. The XEQT and VEQT exposure. XEQT and VEQT each hold approximately 45% U.S. equities. And within that U.S. allocation, the largest weights are the Magnificent Seven, which includes all 4 companies reporting this week. A 5% move in the Magnificent Seven, which happened last week to the downside, produces approximately a 1% to 1.5% move in XEQT. A strong earnings week that reverses last week's sell-off would similarly lift XEQT by 1% to 2%. For a Canadian with $100,000 in XEQT, a 1.5% move is $1,500. Not life-changing on its own, but over a week, where 4 of the world's largest companies report simultaneously, the moves can stack. The Shopify connection. Shopify is Canada's largest technology company by market cap and one of the TSX's largest weights. Shopify's valuation tracks U.S. technology sentiment closely. When the Magnificent Seven fall on AI spending concerns, Shopify typically follows. When U.S. tech rallies on strong earnings, Shopify rallies. Last Friday, Shopify fell as AI spending concerns dominated. Yesterday, Shopify recovered plus 5% on Iran ceasefire optimism. This week, the direction will be determined by tonight and Thursday's results. The Fed and PCE this week. The Federal Reserve rate decision arrives Wednesday, and Core PCE inflation data comes Thursday. The Fed is expected to hold, but the press conference guidance on whether September cuts are still possible will move Canadian bond yields and therefore fixed mortgage rates. Core PCE data Thursday will either validate or complicate that guidance. For Canadian mortgage holders watching the rate path, these 2 data points matter as much as the earnings. The TSX is slightly soft today. Markets are a little soft this morning, with the S&P 500 and Toronto each down 0.2%. This is the market holding its breath before tonight. The direction after close will be determined by Microsoft and Meta. If you hold XEQT, VEQT, or VFV, do nothing different based on earnings speculation. You do not know whether Microsoft will beat or miss. Neither does anyone else, including the analysts who set the consensus. Your long-term plan does not change based on 1 week of earnings. Continue your scheduled monthly contribution. DRIP as scheduled. The AI spending story will resolve over months and years, not in a single earnings call. If you hold Shopify directly, tonight's Microsoft and Meta results will move Shopify tomorrow morning. If you have a concentrated position in Shopify, this is a week of elevated volatility. Know your thesis. Is Shopify a commerce platform benefiting from AI tools? Or is it primarily trading on U.S. tech sentiment? If the latter, the next 48 hours are not the time to be making position sizing decisions. What to watch tonight? The specific signals. Microsoft Azure growth rate. Above 31% equals good. Below 31% equals concern. Microsoft CapEx guidance. If raised without corresponding Azure beat equals sell pressure. Meta operating margin. Above 41.4% equals relief. Below equals pressure. Meta CapEx guidance. Any increase above $145 billion equals likely significant sell-off. Tone of both earnings calls on AI return visibility. This is as important as the numbers themselves. What not to do. Do not buy Shopify or tech ETFs before tonight's results expecting a beat. You are speculating, not investing. Do not sell XEQT because you are nervous about AI spending. Your diversification is your protection. Do not check your portfolio every 30 minutes tonight. The results come after close. The market reaction comes tomorrow morning. The bigger picture, AI optimism has single-handedly kept markets afloat in the face of the Iran war, surging oil prices and growing stagflation fears. The AI spending cycle, whatever this week's results show, is not ending. The hyperscalers have committed to multi-year, multi-trillion-dollar build-outs. The question is the pace and the return visibility. This week's earnings are a data point in a multi-year story. Treat them as such. Let's come back to where we started. $725 billion. Amazon, Microsoft, Meta, and Alphabet. 2026. Up 77% from last year's already record-breaking $410 billion. Tonight, Microsoft and Meta open their books. Thursday, Apple and Amazon follow. 86% of S&P 500 companies are beating earnings estimates, blended growth at 37.9%. The broader economy is strong. The AI spending concern is a big tech-specific story. But big tech is large enough to move everything. Apple is up 15% in July for choosing not to join the spending race. The hyperscalers who did join it are down. The market is sending a message. Returns must now match the spending. For Canadian investors holding XEQT, your plan does not change tonight. For Shopify holders, know your thesis and expect elevated volatility. For mortgage renewers watching the Fed, Wednesday's press conference and Thursday's PCE data are the rate signals to watch. The AI investment cycle is the defining financial story of 2026. Tonight's earnings are the most important installment yet. Watch the Azure number. Watch the Meta margin. Watch the CapEx guidance commentary. And then get some sleep. The market reaction comes tomorrow morning.